Hello everyone, this is Karen Kent. Today we are going to work on problem 14.1. Problem 14.1, let's see what the question is asking us to do, and then from there we could try to do the entries. So first, what the required is using a factor table, a financial calculator or Excel function, present value, calculate the amount used to record the notes payable issuing in exchange. So what happens is that Adventure Incorporated purchased a metal building to build a new roller coaster on December 31st, 2020. Adventure provided $500,000 down payment and agreed to pay the balance in equal installments of $200,000 every December 31st for 5 years. So what we could do is we could do it using a finance calculator, since that's what we're learning. So what they did is we want to know how much the roller coaster should be recorded. So your N will be 5, your payment, how many payments we're making a 200,000 payments, and we're making 5 of them, and we're not going to make any payment at the end, so your future value is 0. And what is the interest? The interest is 9%, and we have to compute the present value of our payments. So if we do the present value of our payments, present value, and then it should come up to, according to my calculator, it came up with 77930. So that's the number you should come up with it. So what they did is they agreed to make 5 payments of each 200,000, and that the present value of those payments is 777,930, plus they made a down payment of 500,000. Altogether, the machinery is going to be worth $1,277,930. So what you could do is you could use an Excel sheet, or you could use that the formula the table that we did. So the next one is asking us to prepare an installment note repayment schedule for the term of the note. This is similar to what we did when we did an amortization table, and this is just a little different. So in this case, we have a cash, we have an interest expense, and then in this, we worked it out, a premium or a discount. In this case, it will be called a principal payments, and then this is same, it is a carrying amount. So in this case, it's a carrying amount. We started off with 77930. So that's what we started off with. Then what we are going to do is we have the dates. The dates will be December 31st, 2021. The cash we paid was the payments were making a 5 payments, so that's the cash that you paid. So we are going to make, how many payments are we going to make? 5 of them. So let's write it 5 of them, so that we know we are going to have a same 5 payments. 1, 2, 3, 4, and 5. So when we make a 5 payments, we pay the interest. The interest is calculated using the rate that is given to us in the question. In this case, the rate is given 9%. So my interest is calculated using the 9% on the carrying value of the note. So when I multiply by that, let me check what number do I get. 777,930 times the 9%, and I get, I'm going to round it up, 70014, and then difference between those two is the principal that we paid to them, and the principal we paid was 9129, and then from there we are going to minus it. If we're going to minus it, we are going to have a principal that is payable. That becomes the carrying value. So the difference is going to be at the after the 5 payments we made, our principal will be 0. So when you calculate your next payment, which is your second payment, you're going to take the carrying value of your bond, you multiply by the 9% to calculate your interest expense. In this case, it is 558,315. I take these two numbers and minus it from each other. Once I minus it from each other, I will get a balance that I paid off for a principal. So this is so you can continue finishing the table, and let's see what the other part of the question is asking us to do. The C part of the question is asking us to do: prepare the journal entry that would be recorded for the purchase and for the payment and interest for 20, 21st, 22, 23, 24, and 25. So now what I'm going to do is, we could continue finishing this table, but I'm sure you could finish the table yourself. But I'm just going to show you how we are going to complete we completed the first 2 years. So what we're going to do is we're going to show you how to do the entry for the first 2, and then you can complete the table for the 23, 24, and 25, and do the and complete the entries what we did here. So let's do our first entry is for the purchase. So when we purchase, and this is your C, when we purchase an equipment, what did we did? We got an equipment. So your equipment is debit. How much is a debit? 1277930. From there we paid cash, which is your down payment, which is going to be your credit, and then we have a notes payable. So we have a note payable. So notes payable is for the difference. In this case is 777930. And then we are going to show you how to do an entry for the 2021, 22, 24, and 25. So in this case, we're going to show you the first. Actually, this is our first one, second one, third one, and the fourth one, the fifth one. So let's do that. So my first entry is for the interest expense and the notes payable and the cash. Of course, we're making a principal payment. So my first entry is on December 31st, 2021, and the cash we paid was 200,000, and you're going to debit the notes payable. Your notes payable is for the principal that we paid out, which is 129,986. And then we have an interest for the first year, which is going to be 70,014. So that is your interest expense. So this is the first entry, and the second entry we're going to do it on the 22nd. The only thing is going to change is your principal and your interest expense. So let's do that entry. And then 31st, 2022, we have a debit notes payable. When we debit the notes payable, which is going to be 141,685, and then we have a interest expense. Whatever we calculated, our cash payment is going to be the same because we're making the 5 payments. And then in this case, the interest expense is 58,315. So what you could do is you can continue finishing the 23, 24, and 25 when you finish the table. Now the next question is asking us to do is a digging deeper from the lender perspective. What are the advantage of installment note compared to the interest bearing note? And now if I were to sing it, when you have a installment note, and then there's an interest bearing note, you're paying interest on the both, but when you have an installment note, it reduces the risk of collection for the principal as a due at the end of the note. So when you're making an installment, you're making the principal as you go, so there's no principal at the end of the at the end of the term. So but if it's an interest bearing note, that you have to make a principal payment at the end. So that's the only difference, is that you're making a payment for your notes payable as you make the installment payments. So that's the difference between the both, is that one has a risk of collection principal at the end, the other one does not have a collection at the end. So let's see if we could do the next problem. Our next problem is your problem 2, and problem 2 we needed to know what the question is asking. In other words, I did not ask you to do A and B because those are just the theory questions. I'm not going to waste your time reading the theory to you. So what we're going to do is we're going to do C and D and E. So what the question is asking you to do is, on June 1st, 2020, McDonald Corporation approached Silverman Corporation about buying a parcel of undeveloped land. Silverman was asking $240,000 for the land, and McDonald saw that there was some flexibility in asking price. McDonald did not have enough money to make the cash offer to Silverman and proposed to give in return for the land a $300,000 5-year promissory note bears an interest rate of 4%. So when you're given an interest rate, that means you need to calculate the present value of your note. So we have a interest, in this case on this promissory note, we have a coupon rate which is 4%, and we have a marker rate which is 10%. Can we calculate the present value of our bond? Yes, we could calculate the present value of the bond now. Now the question is saying that if you look at it, the Silverman on the other hand could borrow the funds at 9%, but they did not borrow it. So this does not apply to us because they didn't borrow the funds, they got the note. So that extra information is there that we don't need. So let's see if we could calculate the present value of our note. We know that your I is equal to your 10%. Your N is, we got, when did we get the note? So they're saying that it is due on the 2020, it's a 5-year note, so N is equal to 5. Your payment is equal to 300,000 multiplied by the 4%, and that which is going to be your 12,000. Your face value of your note, promissory note, is 300,000, and then what you're going to do is you're going to compute your present value. In this case, the present value is 231,766, and since we calculate the present value of our note, now what we could do is that they did not ask us to do the journal entry, so we're good that we did not ask. Oh no, they did ask us to do the entry in D. So then they're saying calculate the purchase price of the land and prepare the effective amortization table for the term of the mortgage notes payable that is given in exchange. So the first thing we needed to do is to calculate the amortization, and they're using an effective method. So let's see if we could calculate it. So now again, these amortization tables are similar to what we've been working out. We have a cash, we have interest expense, and then we have a discount or a premium. In this case, the present value of our note is 231,766, and the face value of the bond is 300,000. So this is a discounted bond. How much is the discount, which we're going to amortize over the life, which is 5 years. So we started off with 231,766, and then what we have is we have an amortization. When we have an amortization, we are going to amortize every year. So this is cash is calculated using a 4%, and it's always use the face value of the note or the bond. In this case, it will be 12,000. So your 5 years, your interest, the cash amount does not change. So you're going to have 5 payments. 1, I have an extra 0, 1, 2, 3, 4, and 5. My interest expense will always be calculated using the carrying value. My marker rate or yield rate is 10%. So then I can calculate my 231,777. So, and then difference between those two is what we paid it out for the what we paid, what we reduce our amortization. So what you're going to, and since it's a discounted bond, we are going to be adding it. If I'm going to add it, I needed to add the carrying value to the amortization. So let's see what the number is. It's 242,943. So of course, then the next year when it comes, you're going to take the new carrying amount, which is 242,943 times your 10%, and that will give you 242,994, and then you minus it from each other, so that will be 12,294, and then what you're going to do is you're going to minus it. That will give you 255,237. So you could just finish all these table, and then by the time we come to the 5 year, our number should reach to the 300,000. That's what the note is for. So let's do the first entry, and then we could I can show you how to do the entries. So now what the question is asking us: prepare the journal entry for the purchase of the land. When we purchased the land, what we did is we calculate using the present value of the land. So that will be your debit the land, and credit will be your notes payable. Notes payable will be recorded using the present value of our note, 231,766, and then that payment is made on June 1st, when did we bought it? We bought the land on June 1st, 2020. So now what happens, we needed to know when the company's year end is to see if there is any adjusting entry we had to do. Did they ask us to prepare the adjusting and require the end of the fiscal year and the first payment on June 31st? Did they tell us in the question that when their year end is? I did not see it, so let's see when their fiscal year is. In this case, I do not see the I don't see anything that says anything. So I think I remember seeing it in the solution earlier on, that there was a December payment. So in this case, if there's no year end, I don't see it unless you are able to see it when you are doing it. So if you see that, if there's a December 31st, I know prepare and adjusting required at the end of the fiscal year. To me, if they're saying it this, there has to be a fiscal year. Let's make it that their fiscal year is December 31st. So let's make it that their fiscal year is December 31st. I don't see it, and then maybe I am not seeing things at this point. So my my year end is December 31st. We wanted to know how many months are gone by from the time June 1st. So if I were to do it, I have to count the month of June, July, August, September, October, November, and December. So there's 1, 2, 3, 4, 5, 6, 7. So altogether we have 7 months that are gone by. So what we did is we calculate the first payment. First payment is for a year. All we had to do is convert it into 7 months and do our adjusting entry. So when we do it, our adjusting entry, you're going to have an interest expense. So your interest expense, I'm taking it from here, which was 23,000 177. And what you're going to do is you're going to multiply by 7 divided by 12, and you're going to do the same thing for the notes payable. In this case, it's not a bond payable, it's a notes payable. So our notes payable will be, what you're going to do is you're going to take the amortization. That's what we have, because now we have a note. So it's not an amortization, you're paying a principal. In other words, you're paying a principal. That is going to be your 11177 multiplied by 7 over 12, and then you're going to say interest payable, because we do not have a cash when we do an accrual entry at the end of the year. When I use the number, so this number will be 13,520, and then since it's a discounted note, this will be a credit, and that will be a credit, and this amount will be a debit. So let's see, because it is a discounted note, so it is a discounted. If it's a discounted note, I am going to do notes payable. Your notes payable is going to be your 11177 multiplied by 7 divided by 12, and that will give me 6520, and this is your 7,000. So that will be your first adjusting entry on December 31st, but our first payment is not due till June 1st, 2021. So in this case, we already recorded the payment for 7 months. Now what we are doing is we're recording the interest for the next 5 months. So for the next 5 months, and then also whatever interest payable we have to get rid of that interest payable. And what we have to do is debit the interest payable of 7,000, and then we know that we're going to make a first payment, that's cash of 12,000. Now we also have we already record the notes payable for the 7 months, and now we are going to record the notes payable for the next 5 months. So if what I have to do is I take the full amount that the payment was due times your 5 divided by 12, and that will give me 4657, and then what I'm going to do is debit my interest expense. I think I had that number on my calculator. That's what I was trying to do, 9657. How did I calculate that? I'm going to take my full year's interest, multiply by 5 divided by 12 to get your $9,657. So let's see what the other part of the question is asking us to do. Oh, well, we are done. In this case, that was the part E. I think we have one more problem to do, which is problem 4. That is also bond amortization. If I get chance to record it again, I will record it. If not, that you could do it yourself and then ask me questions when you come to the class. Thank you.